Selling your home, that's a huge financial moment, but unfortunately, most homeowners leave thousands on the table simply because they don't understand the Principal Residence Exemption. Let's change that. I'm Allan Madan of Madan CPA, and I'm a chartered professional accountant, and today I'm going to explain the rules of the Principal Residence Exemption, or PRE, and show you how to maximize your savings. Let's start with the basics. The PRE allows you to sell your primary home without paying capital gains tax on the increase in its value. The concept is simple, but there are some crucial details you need to know. First, what exactly qualifies as a principal residence? Many people think it has to be their main home, but that's a common misconception. According to the CRA, a principal residence must meet 3 criteria. Number 1, it's a housing unit. It is capital property and not inventory, meaning it was not purchased with the intent of being flipped or resold for the profit. And lastly, it is ordinarily inhabited by you, your spouse, or common law partner, or your children in the year being claimed. The last part, ordinarily inhabited, is very important. This language means that you don't have to live in the home full time to be considered ordinarily inhabited. This means even a vacation home like a cottage or a ski chalet can qualify. And yes, even a home outside of Canada. However, you can only designate one property as your principal residence per family unit per year. So if you own multiple properties, you need to be strategic about what home is ordinarily inhabited in the year you decide to sell it. Let's say you own a city home and a cottage. The city home might be your main residence, but the cottage's value has increased significantly per year. In this case, it might make more sense to designate the cottage for the Principal Residence Exemption if you choose to sell it. Remember, it's a year-by-year designation. To calculate the exemption portion of your gain, the CRA uses a specific formula. It looks like this. Let's walk through an example. Imagine you bought a house in 1987 and sold it in 2025. You lived there for all those years, except for 3 years when it was vacant. If you made $1 million profit on the sale of your house and you use this as your principal residence, you'd only pay capital gains tax on 5.5% of the profits. In this example, that ends up being $55,000. To claim the exemption, homeowners must designate the property on Schedule 3, capital gains or losses, of their tax return and on Form T2091, designation of a property as a principal residence. Failing to do this can result in penalties and interest. It's important to note that the CRA might ask for proof that you ordinarily inhabited the property. This could include things like utility bills, driver's license changes, or even neighbor testimony. While audits aren't common, they're more likely if you frequently buy and sell properties. Lastly, let's talk about a situation to be aware of. Cases where a principal residence was determined not to be capital property and thus not eligible for the exemption typically involve taxpayers who have multiple transactions, a history of constructing or renovating a property and selling it, or involve real estate agents. While each case is decided on its own facts, there is typically an element of speculation in multiple sales within a reasonably short period, i.e. 2 or 3 sales over, say, 4 years. For example, real estate agents and property developers who frequently sell homes may have difficulty claiming the Principal Residence Exemption, though it's not impossible. The Principal Residence Exemption is a powerful tool for Canadian homeowners, but it's essential to understand the results and plan accordingly. If you have any questions or need personalized advice, don't hesitate to reach out to us at Madan CPA. We're here to help you maximize your tax savings. Thanks for watching. Don't forget to like and subscribe for more tax tips and financial insights. See you next time.